Upcoming recession. What if the recession isn't coming? Because it's already here. The numbers say we're doing fine. The US economy grew at a 2.5% annual rate last quarter. Unemployment is low. The stock market is holding up. On paper, it doesn't look like a recession, but talk to people, not just economists, and you'll hear a different story. Layoffs in tech and finance keep popping up quietly. Small businesses are trimming hours. Credit card delinquencies are rising. And more Americans are pulling back on spending, not because they want to, but because they have to. This isn't the 2008 style collapse. It's slower, quieter, the kind of downturn that doesn't trigger alarms, at least not right away. So here's a question. Are we on the edge of a recession, or already living through one that just hasn't been declared yet? Today, we'll unpack the signals behind the sentiment and why markets, companies, and households are preparing for something that official data still refuses to call by name. Section 1. The numbers look fine. The moods feel off. On paper, the US economy doesn't look like it's in trouble. According to the Bureau of Economic Analysis, GDP grew at a rate of 2.7% in 2024, and early projections for 2025 suggest we'll stay in that ballpark. Unemployment is still low, hovering around 4.2% as of March, and wages are climbing at a modest but steady pace, up 3.8% year over year. But for many people, something feels off. Consumer sentiment has dipped for the third month in a row. Shoppers are still spending, but the enthusiasm is fading. Retail sales growth is expected to slow in 2025, down to somewhere between 2.7% and 3.7%. For comparison, it was 3.6% last year. Not a dramatic drop, but enough to make economists raise an eyebrow. Inflation is part of the story, but it's not the only factor. People are also uneasy about what's happening on the trade front. On April 2nd, President Trump rolled out a new round of tariffs that impact nearly every major sector. The move stirred up immediate market volatility and reignited fears of a recession. And while Wall Street may still be hanging on to hopes of a soft landing, Main Street is starting to brace for something bumpier. So, while the numbers tell one version of the story, the tone on the ground and in the markets is beginning to shift. Something's building, and it might not be pretty. Section 2. Cracks in the system, where the slowdown is hitting. Dig a little deeper, and you start to see fractures, quiet, steady, and spreading. Let's start with the backbone of the US, economic activity, consumer spending. It drives nearly 70% of GDP, but lately it's starting to wobble. Credit card debt has now crossed an all-time high of $1.2 trillion, and interest rates are sitting at punishing levels, north of 20% for many cardholders. That's a massive monthly burden for millions of households. And with personal savings rates stuck around 4.6%, Americans have far less financial cushion than they did just a couple of years ago. People are still spending, but more out of necessity than confidence, and increasingly on borrowed money. The housing market is another area showing early warning signs. After a short-lived rebound, demand is cooling again. Mortgage applications fell another 2% in late March, and the uptick in delinquencies among first-time homebuyers is particularly troubling, especially those with FHA and VA loans, who are often more vulnerable to financial stress. These aren't luxury home buyers with padded savings. These are everyday families starting to buckle under rising costs and higher interest rates. Then there's retail, the direct pulse of consumer sentiment. Inventory gluts that started building up in 2022 still haven't fully worked their way out of the system. Retailers from big box chains to discount stores are struggling to strike a balance between stocking shelves and managing shrinking foot traffic. Even dollar stores, usually safe haven during downturns, are warning of slower growth. That's not just about shifting shopping habits, it's about thinner wallets. And finally, the mood in corporate America is growing cautious. This earnings season feels more like navigating a minefield. Forecasts are murky, and in some cases, companies aren't even offering them. Delta pulled its forward guidance. United Airlines issued 2 separate outlooks, depending on how the economy holds up. When big players start hedging their bets like that, it usually means they're bracing for impact. Another significant economic risk factor comes from the Trump administration's approach to reducing government waste, championed by leaders like Tesla Inc. CEO Elon Musk. This strategy has already led to an estimated 222,000 government job cuts and the elimination of more than 7,200 government contracts. While proponents of these measures argue that they have saved taxpayers more than $150 billion, the long-term economic impact is still uncertain. On the one hand, these cuts are presented as a necessary step to streamline government operations and reduce unnecessary spending. However, the cost of these savings is felt in the real economy. The layoffs contribute directly to rising unemployment, which could reduce consumer spending and place downward pressure on GDP growth. Lower unemployment and diminished government contracts also have a ripple effect on the private sector. Companies that relied on government contracts may respond by cutting their own workforce, further compounding the issue. As can be seen, it's not a crash, it's a crawl downhill, which is arguably harder to stop. And they're right, this isn't a sudden plunge, it's a slow, grinding loss of momentum that creeps through the system in quiet but unmistakable ways. And the question now is, how long can this crawl go on before it turns into a fall? Section 3. The Fed's Balancing Act. The Federal Reserve finds itself in a precarious position, managing inflation while ensuring that the broader economy doesn't tip into recession. Jerome Powell's higher-for-longer strategy, maintaining elevated interest rates, has had some success in cooling inflation. However, it's also putting a strain on growth, and the challenge now lies in walking a fine line between the two. As of April 2025, the Fed's key interest rate sits at 4.25% to 4.5%, while inflation has shown some signs of slowing down, with the personal consumption expenditures (PCE) index rising 2.5% year over year in January. It's still hovering above the Fed's 2% target. Powell and his colleagues are keeping their foot on the brakes, cautious about the risk of letting inflation run too hot again. San Francisco Fed President Mary Daly has even signaled that while rate cuts could come later this year, the current situation demands patience, and there's no rush to change course yet. But external factors are complicating the Fed strategy. Recent tariff hikes have added inflationary pressure, making the Fed's job even harder. On top of that, political turbulence is making waves, with discussions about the potential dismissal of Chair Powell, raising concerns about the Fed's independence and its ability to make sound, data-driven decisions. Historical data suggests that the effects of tightening cycles can take 6 to 12 months to fully materialize. Given that the current tightening began over a year ago, the economy is entering that window where we may start to feel the consequences of higher rates. In fact, tightening cycles have historically led to recessions after about this amount of time, and we're now within that critical period. For the Fed, the challenge is striking the balance. Under tightening risks, letting inflation get out of hand, while over tightening could push the economy into a steep decline. The next few months will be pivotal in determining whether the Fed can pull off a soft landing or if the economy is headed for rougher times ahead. Section 4. Global Spillover. The economic challenges we're facing today are not limited to the United States. They're rippling across the globe, creating a delicate and interconnected economic environment. As economies worldwide grapple with their own issues, the broader landscape becomes increasingly fragile. Europe's narrow escape. Europe narrowly avoided a recession in early 2025, largely thanks to a mild winter and substantial energy subsidies. However, while the region managed to sidestep a major downturn, demand remains weak and the economic outlook remains uncertain. The European Central Bank, ECB, is under growing pressure to adjust interest rates in an effort to stimulate growth. But with economic conditions still volatile, it's unclear how effective these measures will be in the long term. China's stimulus measures. China's economy showed a better than expected growth rate of 5.4% in the first quarter of 2025. But beneath the surface, serious challenges persist. A deepening property market slump, rising youth unemployment, and deflationary pressures continue to weigh heavily on the nation's economy. In response, the government has ramped up its fiscal spending, pushing the budget deficit to 4% of GDP, and introduced stimulus measures to support economic recovery. However, These efforts are proving insufficient in the face of long-term structural issues, leaving China's economic future uncertain. Emerging markets under pressure. Emerging markets are also facing a trifecta of challenges: a strong US dollar, declining exports, and capital flight. The strengthening dollar is making exports from these countries more expensive, reducing global demand for their goods. At the same time, capital outflows are increasing, putting further strain on these economies. These factors are deepening the vulnerabilities of emerging markets, making it harder for them to maintain stability. Section 6. What the markets are telling us. Markets are showing signs of growing caution as uncertainty looms. Investors are reacting to concerns about the economy, and the signals coming from the markets are hard to ignore. Yield curve inversion, a classic recession warning. The yield curve inversion, where short-term interest rates are higher than long-term rates, remains a key indicator for recession. Historically, whenever the yield curve inverts, a recession has followed within the next year or two. Right now, the spread between the 2-year and 10-year Treasury yields is negative, signaling that investors are worried about an economic slowdown. Stock market volatility, sensitive to Fed actions. Stock markets are more volatile than usual, with the S&P 500 seeing big drops recently. The market's wild swings are largely driven by how sensitive it is to any signals from the Federal Reserve, especially when it comes to interest rate hikes. Investors are on edge, and even small changes in the Fed's stance on the economy are causing major reactions in stocks. Credit markets, growing caution. In the credit market, things are getting riskier. The difference in yields between safe and risky bonds, also known as spreads, has widened recently. This suggests that investors are becoming more cautious about lending money, fearing that the economy could take a downturn. Safe haven assets. Investors turn to gold. In times of uncertainty, many investors turn to assets like gold for safety. Gold prices have surged in recent months, reflecting concerns over inflation and global instability. This is a sign that people are looking for something stable to hold on to during turbulent times. Tone insight. Investors aren't exactly panicking. They're preparing for the worst. Hedging or making moves to protect themselves from risk is often a smart strategy during uncertain times. It's a way of staying cautious while still keeping an eye on future opportunities. Section 5. Is this a slow burn recession? Traditional recessions are often abrupt, marked by job losses, market crashes, and sudden demand shocks. But what we're experiencing now feels different. Instead of a sharp downturn, we're seeing a steady erosion of purchasing power, confidence, and investment appetite. Some are calling it a rolling recession, where different sectors slow down at different times, rather than everything grinding to a halt all at once. For example, the housing market has been struggling, while consumer services have held up better. This uneven decline has prevented a full-blown recession from materializing, but it still signals economic strain. J.P. Morgan's chief global economist, Bruce Kasman, recently raised the chances of a U.S. recession to 60%, citing the ongoing impact of tariffs and trade disruptions. These tariffs, which are essentially like a tax hike on the economy, have strained supply chains, pushed prices higher, and squeezed consumer budgets. Similarly, J.P. Morgan CEO Jamie Dimon has expressed concern about the economic landscape, suggesting there's a 50% chance of a recession. His worries stem from trade tensions, inflation, fiscal deficits, and asset price volatility. As a result, businesses are becoming more cautious, delaying hiring plans, pulling back on mergers, and refraining from offering earnings guidance due to uncertainty. This is where the metaphor, "it's not the fall, it's the slow unraveling of the parachute," comes into play. Instead of a sudden crash, we're witnessing a slow and steady decline across various sectors, which could stretch out the economic pain over a longer period. In the end, while the U.S. may not be in a typical recession, the slow unraveling of economic momentum across key industries paints a picture of a rolling recession that could last longer and affect different sectors and phases. Bottom line. Building financial resilience before a downturn is a critical shield against potential economic dislocations. For households, this means preparing for longer job searches and less income replacement through unemployment benefits, which may cover only 40% of prior earnings. To buffer against these gaps, it's advisable to build an emergency fund capable of covering 6 to 9 months of essential expenses, a more robust cushion than the typical 3 to 6 months recommended during stable economic periods. For investors, a defensive repositioning of portfolios is necessary. Allocating more funds into less cyclical sectors like healthcare, utilities, and consumer staples, as well as high-quality fixed income, can provide more stability. These sectors have historically performed better during economic contractions, showing decline of 30 to 50% less than the broader market. Additionally, it's essential to reassess fixed income duration risk, as intermediate-term government and corporate bonds could offer both income and potential capital appreciation if central banks pivot toward monetary easing. Households and businesses alike must also focus on reducing debt, prioritizing the elimination of variable rate obligations, such as credit cards and adjustable rate mortgages, will minimize the financial strain in periods of economic stress. High household debt service ratios, particularly those exceeding 35% of take-home pay, have proven to increase the likelihood of financial hardship during recessions. Similarly, businesses should focus on optimizing working capital, extending debt maturities, and expanding credit lines to buffer against tightening lending conditions. Ultimately, the road ahead remains uncertain, but resilience and preparedness can mitigate the challenges of an economic slowdown, ensuring both individuals and businesses are equipped to navigate the rough waters of the next downturn.